So the worst thing that could happen to you as an investor is to lose your source of income. So today, I'm going to give you 4 tricks to avoid dividend cuts.
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend Growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique, and we had a lot of fun talking about a lot of topics before we started recording. So even though we are going to talk about kind of like a bleak subject, I think we're going to have a lot of fun, Vero, right?
For sure, Mike. I mean, like you said, for dividend investors, a dividend cut is an investment failure. It can destroy our retirement plan, but it also affects our conviction. Fortunately, there are ways to avoid most dividend cuts, and we'll share them with you today. So yes, it should be fun.
Yeah, and to be fair, I mean, I hate to bring it to you, but you will still suffer some dividend cuts. The point here is to minimize the number and minimize the impact in your portfolio as well. I've been a dividend growth investor since 2010, so that makes me like 14 years in the process. And I had like those mishap a few times, not too many, but whenever it happened, it sucks because as you said, Vero, it's not just about the income or the performance. It hurts your ego, it hurts your strategy and your conviction. And now you're thinking, well, if I have like 5 or 10 of them in my portfolio, what's going to happen? So am I investing the right way? Do I follow the right process? And you get into a lot of those questions. So today we're going to try to shed some lights on how you can avoid them. But yeah, there are some events in the market that will still crash your portfolio from time to time. So therefore, diversification will always be your better friend.
Okay, so the current environment is made of multiple uncertainties, and as investors, we could have the feeling that we have absolutely no control over dividend cuts. However, most of the times, there are noticeable signs before a dividend cut happens, and the first one is being the market itself. So number one trick is trust the market and look at the yield. Can you explain that for us?
Well, a lot of investors will tell you that the market is crazy, and they're partially right. I mean, we do see overreaction, either positive or negative, and this is also why we have market crashes. So besides that, when there's not a market crash, when the market is going all right, or slightly up, or slightly down, some companies will underperform. And therefore will show a high yield. So the high yield is not enough to sell a stock and get rid of it, of course, but it's a red flag. It's a red flag telling you maybe you should look into the financials, maybe you should look into the financial business model and understand what's going on here because there must be a reason. The only reason why a yield is high is because there's not enough demand to buy the stock. So therefore, the stock price doesn't move or goes down, while the dividend either doesn't move or goes up. So that's mathematically speaking, that those are the only reason. So if nobody wants to buy the shares that you have in your portfolio and the stock price keeps going down and you still have a high yield, don't you think that maybe it's because there's a reason? So sometimes, of course, it's underrated, exaggerated from the market. But a lot of times, in general, when nobody wants to buy a stock and there's a high yield, it's because most people think this company is struggling. And as an investor, you don't want to have a struggling company. And of course, chances are, a lot of those high yielders will cut their dividend way before those that shows a yield of 2%.
So in other words, if a stock shows a yield higher than its 10-year average, it's a big red flag, right?
Yeah, depending on how big the discrepancy is, it could be a buying opportunity or it will be a red flag. So in other words, whenever the company is not trading at the same, not offering the same yield as it used to, it just tells you that something has changed in the environment and that or in the business. And this is super important. I mean, keep in mind, Enbridge used to offer a yield around 3% 10 years ago. And now we're like 6, 7, 8%.
Mm-hmm.
Definitely. And I'm not saying that Enbridge is going to cut their dividend like by the end of the year. I'm just saying something has changed. They went from a growing business, actually growing their dividend back then by like 10% a year, to a slow, mature business, struggling a little bit on the debt side and offering a 3% increase over the past few years. So definitely the entire thesis has changed here. And this is the reason why I sold my shares of Enbridge back in 23, was
Mm-hmm.
not to necessarily avoid a dividend cut, but just to realize, oh, the reason why I bought it in 2017 are not this, like they don't exist anymore. Fast forward to 2023. So you always have to review your portfolio, review quarterly your stocks, and making sure that the reason why you have a company in your portfolio are still valid. And one trick to dig a little bit deeper, because sometimes you're just going to look at the stock and say, oh, it's all good, everything's fine. But if you see that the yield, it keeps increasing. So for example, I'm starting to ask myself a little bit more question about TELUS in my portfolio than I used to 5 years ago. But
Mm-hmm.
now I'm like, yeah, this one requires a little bit more attention than other companies in my portfolio. And one of those reasons is the market is telling me we don't like TELUS. Maybe they're wrong, but do you really want to always bet against all other investors? A few companies in that in your portfolio could work, but if like half of your portfolio is like this, you're placing a pretty high bet against the market. I'm not sure I would go there.
Mm-hmm. Okay, so technique number 2 is to beware of an absence of dividend growth. How does it impact the dividend safety?
So no dividend increase tells you that the company has little room in its budget, and you don't necessarily want a business that is tight on their budget, right? Because
Mm-hmm.
if they do not have more room to increase their dividend, chances are they may have difficulties as well to invest in their research and development department, in their marketing, or acquiring or retaining talent, making acquisition. All of those things are off the table at this point. A lot of investors, and we discussed that in the stocks that I hate not too long ago, will say, oh, it's prudent management if they don't increase their dividend. I'm like, yeah, well, it's bad management to get there. And it's really the problem. Why did you let the business get to that level where there's no more room for an increase of dividend? The other problem I see with an absence of dividend growth is the inflation. So it is a 2, 3, 4% dividend cut every single year. Because if you retire on $40,000 today, generated by your high yield portfolio, well, in 20 years from now, so you go from like retiring at 60 and now you're at like 80, 85. Well, that same $40,000 is not going to make it. And then
Mm-hmm.
like cost of healthcare is going to increase, cost of grocery bills are going to increase, everything's going to increase, and you're stuck at $40,000. I mean, that's a huge dividend cut that you never saw coming and never read in the newspaper, but it's
Right.
still going to happen. So on the one side, even if the company has staked their dividend for a very long while, like 5 years or 10 years with no increase, you're going to say, oh, well, they can still do it. Yes, but you're still suffering from a passive dividend cut. That would be actually the best case scenario. The worst case is many cases we see a company with a weaker and weaker dividend triangle. So revenue and earnings slowing down, no dividend growth, and eventually, big shocker, a dividend cut. And when
Right.
the cut happens, the stock price keeps on going lower and your income is already low. So you're not able to turn around and invest in something else, because then if you sell your shares, you're going to think I'm losing too much and I'm not going to be able to replace that source of income. And you're right, but there's no more hope there. You have to do that. You have to select those companies before they get to that point. So as
Mm-hmm.
soon as you hit 12 months with no dividend increases, start doing a lot of investigation and understanding what's happening there.
So, simply put, Mike, you don't necessarily believe in dividend investing, but you're a strong advocate of dividend growth investing, right?
Yeah, definitely. I get the point where dividend investing grew in popularity because I like those napkin math. You know, like you have $1 million, you need $50,000 a year in income. You invest at a 5% yield, and then boom, you get your 50 grand. You don't have to do anything else.
Mm-hmm,
Super simple, effective. Nothing against that. The problem is a lot of those 5, 6 yielders are not going to be able to continue to grow their dividend and beat inflation.
mm-hmm,
And this is where the problem starts. So I don't like dividend investing for the income. I like dividend growth investing because it's an additional set of metrics, financial metrics I can analyze and determine if the business is thriving or not. Because a company that is able to increase their dividend for 10, 15, 20 years is a business that goes through recession without any worries, that generates strong cash flow, that has healthy margin, and then can face roadblocks in their path and still reward shareholders.
mm-hmm.
Well, as an investor, this is the type of business I want in my portfolio. So the dividend growth is kind of like the consequence of investing in a thriving business. And this is
Right.
what I like.
Mm-hmm,
And sometimes I have to put like a small exception here because in some cases it's rare, but it happens. So don't ever say, "Oh, absence of dividend growth, I'm selling." There are companies that do not increase their dividend at one point. And it's not because they're struggling. It's actually a capital allocation choice. So company like Nvidia for a while, now they just increased their dividend 24, but before that they showed like, I mean, they're not even paying a dividend. It's like super small, but still they remained at the same thing at the same level for a long time.
mm-hmm.
Constellation Software, I'm pretty sure that they forgot to just erase the dividend in their board minutes. WSP Global as well. But what they have in common is they decide to use their capital to re-inject that in the business to generate more value. So they saw more opportunities inside the business instead of giving back money. And they're just telling their shareholders, you know what? Trust me with your money. I'm going to make the business grow even faster with it instead of rewarding you with a small dividend payment.
Mm-hmm.
In those cases, that makes sense. But again, you will rapidly identify the difference between a struggling business and a company that makes a wise capital allocation by looking at the dividend triangle. So if I look at Constellation Software, revenues are going up, earnings are going up, cash flow is going up. I don't care if the dividend is not going up. I know that they're doing this because they will reward me with a higher stock price. Nvidia, the same thing. I mean, this one is just out of this world in terms of example, but it's pretty much the same idea. And WSP Global, they just told their shareholders, we're going to use all our capital to grow by acquisition because right now it's the right time to do it. So maybe later down the road in 5, 10 years, they're going to start growing their dividend again if they see less opportunities on the market to create more value for shareholders. But in the meantime, this is how they run it. But you will not see a business telling you this and seeing revenue and earnings declining quarter after quarter. Those are just struggling businesses getting tight on their budget. They have no other choice but to put a pause on their dividend growth policy and eventually may lead to a dividend cut.
Mm-hmm. But Mike, I would still like to act as the devil's advocate for a minute. Are there times that too much growth becomes a danger for the dividend safety?
Oh, that's an interesting question. I'd say that in most cases, when you see a very strong dividend grower, we're thinking like high single digit to double digit dividend growth year after
Mm-hmm.
year. You're going to find them with companies that have incredible strong dividend triangle, very low payout ratio, like in the 20 or the 30%, and the ability to grow forward even more. So companies like Costco, Visa, MasterCard, Alimentation Couche-Tard, see, like two in a row. I have to talk about this one. But those companies are like what I call low yield, high dividend growth potential. However, it will raise expectation in the future. And if a company goes from offering like 10% dividend increases going down to five,
Hmm.
well, maybe it's going to raise a few eyebrows. But on the other side, double digit dividend growth is not necessarily sustainable unless you are able to grow your earnings by double digit as well. So is it like normal to expect that a company for 25 years will grow their profit double digit all the time to match that pace and reward shareholders accordingly? Probably it's just a matter of like there are like seasons of growth and seasons of cash flow in a company's life, and every company will become mature at one point, and then it's a matter of like are they able to find a new set of growth vectors to reignite that growth, such as what happened with Microsoft, for example. So they surfed a long time on their software business, and then they exploded with cloud, and now it's AI. But they were able to find a new set of products and services to go through, because if they would have stuck with Office 365 and Windows, it would have been a pretty solid cash cow, but definitely not a double digit growing company.
Hmm. So of course, the first two techniques that we've mentioned bring us back to the dividend triangle. We already kind of said it. So at number three, we have avoid weak dividend triangles. So maybe Mike, just explain again how revenues, earnings, and dividend growth are like interconnected.
Yeah, so everything is kind of like affecting, like one metric is affecting the other one, of course, because if as a business you're not able to grow your sales, well, chances are you may be able to grow your profit for a short period of time by doing some like cost control initiatives and improve your margin for a short period of time. But over 5-10 years, it's going to be almost impossible to have like stagnant revenue and increasing earnings all the time. I
Hmm.
mean, you could buy back your shares, that could give you some leeway as well, but eventually you'll need to grow your profit. And when we were talking about companies with a high yield, well, often they will show a weak dividend triangle. So the high yield is a red flag. The absence of dividend growth is another red flag. And when you start your investigation, don't start with your investment thesis and the narrative, because the narrative can always be super positive, right? And if you look
Hmm.
at the earnings, it's kind of funny because sometimes you even hear management saying, "Oh, we had a great quarter, like we are super optimistic," and then you look at the numbers and like, "Yeah, I'm sorry, man, but those numbers are going down. So you may be super optimistic, but it's not translating into facts." So here's come the dividend triangle as the trick number three. When you see, because sometimes you're going to see like a slowdown in the dividend growth and a relatively high yield, but not too high. So imagine a company with a 4 or 5% yield. But then when you look at the dividend triangle, you see that the revenues are stagnating, earnings are like going down a little bit, and the dividend used to increase by like 5-6% for several years, and then started to go down to 3 to
Hmm.
2%. And then you're stuck at the 1 penny or a 1% increase. Well, those are red flags. And at this point, maybe you do not have like a super high yield. Maybe you do not have like, and you still have some dividend growth, even though it's like very, very small. So the trick number three is to look at the trends of those three metrics and then try to understand what's going on here. Is it because the company is losing market shares? Is it because consumers' tastes are changing? Is it the environment? Is it the economy with higher interest rates and so on? So that the trend will tell you where to go and where to maybe dig a little bit deeper to understand what's going on. And then you can go back to your investment thesis and the narrative. But at
Hmm.
first, understand how the numbers are moving and where they're going and why. So the revenue, the earnings, the dividend, technically, if everything goes up, it's going to be fine. But then when you can see that one metric is going sideways, it will affect the other two. And eventually, if you wait too long and you don't understand why the company is losing steam, it's going to result into higher yield, no more dividend growth, and eventually a dividend cut.
Right. So, do you have concrete examples of companies with weak dividend triangles that shortly cut their dividend after you notice them?
Yeah, actually, and it's great because we do have like our rating system at DSR, and while it's not perfect, we make mistakes as well. It is a pretty good indicator of like when the company is weakening. So the first one was Northwest Healthcare Property REIT,
Mm-hmm.
nwh.un.to. So this one was easy to identify because they show no dividend increase for a long time. So already you just like, okay, so you have a combination of a REIT offering a high yield, no dividend increases. And then when you look at the payout ratio, they're relatively high. Well, there's no point here to stick around with this one and wait until the dividend cut. That happened in 23. It was pretty much screaming dividend cuts all over the place just by looking at the lack of growth, the struggle with the dividend, and the struggle of the payout ratio. Another one that we used to like at DSR, but like
Right.
10 years ago, Walgreen Boots Alliance. So back then, it was a pretty strong dividend grower, a great company with a great narrative. I mean, Walgreens is like one of the largest drugstore in the US. They have like 8,500 stores reaching out most of the population. You're maybe thinking it's like super safe business model, and yet what happened is they started to report hectic earnings. So from one quarter to another, sometimes it was up, sometimes it was down, but it was not really clear. There was no direction there. And the
Mm-hmm.
dividend started to slow down as well. So they didn't start by cutting their dividend up front. They just went from a mid-single dividend growth rate to like a very small one for a few years and eventually took a pause. So you see, it goes by steps. So at first, you just like, great narrative, great business model. That was 10 years ago. And eventually, revenues are like growing, but not super fast. But most importantly, the earnings are not following. So if you have revenues like sales that are growing, but your earnings are not growing pretty much at the same pace, this identify a problem in the margin. So there are like costs that are rising somewhere, preventing Walgreen to make more money. So
Mm-hmm.
already you're just like, yeah, that's not cool. And then you see a slowdown in the dividend increases. So another hint that you should investigate. And the ultimate one was when there was no more increases. So if after 2 or 3 years of low increases, you have a pause, I mean, now you're getting closer and closer to a dividend cut. And best case scenario, you're not going to get a dividend cut, but you're going to have a very poor performance company in your portfolio.
Mm-hmm, mm-hmm. And I mean, when you talk performance, I'm just saying as you described like the dividend triangle, Mike. The price of WBA went from like almost $50, if I see
Mhm.
correctly, to like $12, around $12 as we record. So it's so like harmful for investors.
And you see how like between 2019 and 2022, the revenue were increasing, the earnings have been hectic, the dividend growth slowed down during that period, and the stock price barely moved during that time.
Mm-hmm.
And after 22, what happened is less revenue growth, weaker earnings, no dividend increases until the company cut their dividend at the end of 23. And all the way down, the market was telling you that sign, all like it was like screaming, we are concerned about this business. We are concerned about this business. So you went from like roughly $50 to $40 to $30 to $20,
Mm-hmm.
like slowly but surely getting to that point where boom, there's a dividend cut. So it was telling you up front, like 1 year, 2 years in advance, that this business is struggling.
Mhm. And this mic makes me think about the dividend rockstar list. So, listeners, if you'd like to get a list of stocks that show a positive dividend triangle, I invite you to download the rockstar list at thedividendguyblog.com/rockstar.
Yeah, I really like to start my stock research with the Rockstar list. The reason why is I narrow down the choices of companies that could be a candidate in my portfolio with only businesses showing a positive dividend triangle. So it's telling me, this list is telling me those companies have been doing great over the past 5 years. It's a good starting point, but it's not the end of your journey. You need to
Mhm.
dig further. You need to look at the trends. You need also to look at which companies in which sector should be a good fit in your portfolio. But if you're looking to narrow down from thousands of choices all the way down to a few hundreds, and then if you filter by sectors, then you're going to get maybe like a dozen, maybe
Mhm.
less of good candidates in your portfolio. That makes your stock research very efficient and very clear to get the next good stock for your portfolio.
Okay, so the last technique is to avoid putting the narrative over the numbers. You've explained this one a few times on the show, Mike, but it remains a key point to avoid dividend cuts, right?
Oh yeah, big time. I like to discuss this mistake because I like to be transparent, but I got burnt with Algonquin. We discussed that stock that I
Last
hate.
week. Yeah.
Yeah, so, but here's the thing: is I've put too much faith into a sexy narrative of growth by acquisition, and I kind of like discarded the numbers that were not matching my investment thesis. So I'm like,
Mhm.
yeah, but they continue to grow their revenues, they continue to grow their dividend. The pair that they were like just very bad management and just kept on spending even though they knew that they were making less money. It's like, oh, let's buy a new car. I just lost my job. So that's kind of like reflex from management that happened. So when you invest in a business in the first place, when you buy shares of a company, you have a story. So you have the reasons why you have this company in your portfolio or why you
Mhm.
like it, and you have the numbers. So the story is your investment thesis, is all the reasons why you think this business is going to do well in the future. So the business model that you understand correctly, the growth vectors, the moat, all the competitive advantages, and so on. And then you have the numbers that must back that story. So when I tell you, oh, I love National Bank for all the great reasons that I always mention on this show, well, if you look at the numbers are also better than all the other banks. So
Mhm.
there's also a reasoning where you just don't tell a story to people or to tell yourself, but you actually make sure that this story is backed with something that makes sense.
Mhm.
So with AQN, this is what I did. I let the numbers aside a little bit and then just focused on the selective investment thesis. uh, I see that many times. The most common thing that I hear when a company is struggling is, oh, this company has been around for a long time, or this company has been in paying dividends forever or
Mhm.
growing their dividend for a long time. Well, I bet that AT&T, Kinder Morgan, Walgreens shareholders also thought the same thing. So it's just not a reason. It's not because you've been around a long time that you're going to continue to thrive in the future. I remember when I was a kid, I loved to go at Zellers and at Toys R Us. Well, my kids are looking at me like, what are you talking about, Dad? They don't exist, those things. Like, what, like Toys R Us? Like, you just like order everything online or like play on your phone? And there you go. So things change. Even the best things change, right? So you cannot be thinking just, oh, I'm gonna go with that story and I'm gonna ride my pony to like unicorn lands. Not gonna happen.
But Mike, I just want to add like a quick note about that. Like you've mentioned, the numbers and the story have to match, but then you can take a bit of like a couple of quarters before acting, though, because I mean, it's not like, okay, so the story and the numbers don't match for the last quarter, so I'm gonna sell it. It's not that quick either, right?
You bring a very good point. It's important not to be trigger happy either. And this is where like the blurry line starts, because yes, if a business shows a bad quarter, and we discussed a few one this year on the show, such as Starbucks and Equinix and most recently Nike had like terrible quarter. I mean, the quarter was okay, but the guidance for 25, they basically told the market, yeah, well, we have to revise and like sales expectation, they suck for next year. So they're not just saying we struggle today, we're going to struggle for at least 12 months. So the market hated that. The stock price went down by 20%. So that is an overreaction. And I'm not saying I don't have like Nike in my portfolio, but I'm not saying that you should buy more or just sell altogether. What I'm saying is what is important, monitor your portfolio quarterly. When those things happens, try to narrow down why it's happening and what's the context, and then try to find out, as I mentioned earlier, a plan like how Nike is going to reverse that in 26, 27, 28. So if they're just saying, oh, well, it's going to be a tough ride and we hope to make more sales, that would be very bad. That is not like good management. But if management says, oh, we're going to do this, we're going to open like new stores, we have like a new brands that are going to be launched, and we have like a lot of like other marketing operations that are coming up, well, then you can decide to give the company, like, I would say between 6 to 8 quarters. So in a year and a half, 2 years. I mean, those are like big companies. It's not always easy to turn things around like over like 90 days, but you keep monitoring them. That's pretty much what I'm doing with Dallas, for example. Like Dallas, right now, the earnings are not backing my investment thesis, not at all. So I do have the revenues, I do have the dividend, but without the earnings doesn't mean much over the long run. It is like, it is a temporary situation where either Telus is going to tell us, well, that doesn't sound right. Telus is going to say, well, we are tight in our budget, and in 25, there's not going to be a dividend increases. And then we're going to say, oh, okay, we're in deep trouble. Or they're going to be able to conduct that narrative where they generate more cash flow, and the cash flow metrics have been improving, not incredibly, but they have been on the positive side over the past 2 quarters. So maybe we're going to get there. But we are at this stage where I'm a few quarters away to determine if this one is a high risk, high reward, or just another company that will eventually let us down. But it's not clear yet in the story because they do have growth vectors and because the narrative is remained strong. But again, if the story is nice, but the numbers are not there, you will have to make a choice. So the key here is really to monitor every single quarter and then to determine what do you track. So for Telus, what I told my members and what I do with my portfolio is I track cash flow metrics, because cash flow metrics will dictate if they are able to grow their dividend or not. And it's also related to the investment thesis where they benefited from 10 years of low debt, low interest rates on their debt to invest in the business and generate more cash flow. So now it's about time that this story happens. If not, I will eventually have to sell my shares of Telus. Now, the great thing is if you go with diversification, Telus is like, I think like 4% of my portfolio. So of course, I'm not going to be super happy to sell it. Right now, I'm not losing money because I've been a shareholder for a very long time, but I'm definitely not a big performer right now. If I sell without a dividend cut, I can move on and say, well, it's like, it's half a mistake. But if I hold on to this one thinking, oh, everybody has a cell phone and it's all going to be fine because Telus has been around forever, well, maybe I'm going to wake up in 2 years from now with a dividend cut and having like share price at like $10. And now I'm going to lose like more than 50% of my investment. And this is not what you want. So that's why, as you said, you want to give some room, some time to the business to turn things around. But at one point, you have to also make sure that maybe what you believed in, maybe you got it wrong. Or maybe management was really sincere. Because I mean, of course, their goal is not to destroy businesses, but they were not able to deliver on their promise. And now it's time to leave this one and move to a better opportunity, a more well-managed company.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see 2 very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. So we couldn't do this episode without also adding some notes on the payout ratio. There's a common belief that a good payout ratio is under 80%. Actually, we discussed this in our Things We Believe That Aren't True episode at thedividendguyblog.com/173. But why is this misleading?
Well, it's misleading because any financial metric, if you just take the number without the context and without understanding how it's calculated, it's completely useless.
Mhm.
So, yes, by a general definition, in most cases, a payout ratio under 80% is a good thing. However, the payout ratio is based on earnings, and earnings are based on accounting principles. So, for example, Broadcom back in like 2018, 2019, before the big surge, showed like payout ratio well above 100% for a long time. But when you dig a little bit more, so again, if you see a high payout ratio, this is definitely a red flag. You have to investigate. But when
Mhm.
you dug in a number, you realize that Broadcom grows by a lot of acquisitions. And when you make those acquisitions, you have charges for that. And you also have amortization. And that amortization was bringing earnings down and therefore a payout ratio above 100. But that amortization is not real money. So Broadcom kept on increasing its dividend year after year without that because it's not affecting their cash flow. So it's really important to understand which type of payout ratio you look at, how it's calculated, and for which industry as well. So sometimes people say, oh, I'm going to look at cash flow payout ratio. I'm like, yeah, that's smart. But the classic cash payout ratio will not include debt as a way to reduce the cash flow
Mm.
payout ratio. It's just going to say, okay, so you generated like $100 of cash flow, and you're paying 120 in dividends. So therefore, you're in negative territory, and you have to get debt to finance your payment. It is half true because in that case, if the company also borrowed $500 to invest in the business because they made an acquisition, well, therefore they could have like it's either they cut the dividend to make the acquisition or they keep the business rolling and they borrow money to invest for the future, which is totally understandable, but it will completely destroy your cash payout ratio. So it's always a matter of understanding what you're looking at and putting that into a context, knowing what the business is doing at the time you look at those metrics.
Mhm. And investors should also look at the payout ratio trend instead of just a number, right?
Yeah. So once you have found the right payout ratio to track, well, if it keeps increasing, well, chances are it's not a good sign. And you'll see again, most of the time what happens is if there's a weak dividend triangle, the payout ratio will tend to go higher. And if you have a strong dividend triangle, well, revenue, earnings, and dividends are growing, chances
Mhm.
are the payout ratio will either stay the same or sometimes even go lower. But in increasing payout ratio, definitely another red flag for sure.
And by the way, listeners, if you download the Rockstar list, you'll also get a link to more free resources, including a complete newsletter about payout ratios and how to read them like a pro. So again, thedividendguyblog.com/Rockstar. Now, Mike, this means a payout ratio over 100% can sometimes be sustainable and not be a sign of an upcoming dividend cut, correct?
That's correct. So it's definitely a must that you have to investigate. You have to look into this to understand, but you may find a pretty good explanation and therefore you're going to be fine and you can move on. But again, it goes back to the whole circle where you need to know
Mhm.
what you own and why you own it. And therefore, you need to be able to understand the business model and how the numbers are affecting the payout ratio.
Listeners, for the best dividend growth stock ideas with metrics, we invite you to download our Dividend Rockstar list. Mike, what will they get?
Well, Vero, for all those episodes that we talk about the dividend triangle, I decided to use the DSR stock screener and pull out the list of all companies showing a positive dividend triangle. So on top of having a lot more metrics in the list, you're going to only have companies showing a positive revenue growth over the past 5 years, positive earnings per share, and positive dividend growth. I even spiced it up, adding the Chowder rule and adding a minimum 5% growth rate for the dividend payment, just to make sure that you search among the best dividend growers there is, and that is for both Canadian and US stocks.
It is totally free and it will be updated monthly. So please download it at thedividendguyblog.com/rockstar. Mike, you have made a quick checklist for Dividend Stocks Rock members who'd like to assess the dividend safety of their holdings. So let's end the episode with these checkpoints as a summary.
So yeah, those are like a quick list of questions that you can easily answer, but if like it's going to also point you towards the which direction the company and its dividend is going. So the first thing is, as the company increased its dividend in the past 5 years and every single year. So if it's yes, well, therefore you're already getting on the right side. If it's no, already put this one on the investigation list. Mm-hmm. Is the dividend growth trend steady or slowing down? Again, do not look at the 5-year growth rate number, but look at the trend, because maybe a company increased its dividend by like 10% for 3 years in a row and then went back to 2% for the following 2 years. So the slowing down is also another red flag. Mm-hmm. How are the payout ratios? Are they above 100%? Are they out of control? So similar to what we have discussed already, if it's above even 80%, then it's a red flag. It becomes a pretty big problem when the company is struggling, doesn't grow their revenue and their earnings, and then shows a high payout ratio. We often see that as of late with REITs, where they show very high FFO payout ratio, like 90%, 95%, 105%, and then no revenue growth, no FFO per unit growth. Well, therefore, after a few years, you're gonna there's no other ways to free up some cash flow for the business, but to cut their distribution. Mm-hmm. What's the payout ratio trend? Again, if it's going up all the time, big red flag. Is there an explanation of the high payout ratio? Are you using the right calculation? So understanding the context, understanding how numbers are calculated, it requires a little bit more time, but if you don't, you're exposing your portfolio to massive dividend cuts. Is the business growing or struggling? So if you have a struggling business, chances are the stock price will go down, the yield will be higher, the dividend triangle will be weaker. See, all of those things are getting clearer and clearer. And I had a member not too long ago asking me about smart center REITs. And he said, yeah, I don't understand the weak rating at DSR. When I look at the dividend triangle, it doesn't look that bad. And I'm like, yeah, but the stock that REIT did not increase their dividend for the past 5 years. And even while revenues are increasing, the FFO payout ratio remains really high. So high yield, no dividend growth, high payout ratio, you're starting to get a pretty solid combination of a company that is not going towards the right direction. Mm-hmm. And of course, looking at earnings per share or cash flow trends. So a company that is getting weak on cash flow will ultimately not be able to increase its dividend. So all of those questions, the main goal is really to take you away from the narrative and going back to the numbers, because you should actually build your narrative based on those numbers and not the way around. Not just thinking the company has been around forever. I'm paying my utility bills every month, so therefore they're going to be there forever. I mean, that is not good reason to hold a stock. Look at the numbers. If the numbers are pointing down, well, chances are the dividend cut is coming. And keep in mind, once it's done, the stock price has been down before. Maybe on top of that, it's going to drop on the surprise, but it would probably be on the downtrend for 2 years before there's a dividend cut. So the market is trying to tell you something. It whispers at your ear. Maybe you should listen.
Okay, so thank you, Mike, for helping us invest in safe dividend stocks. Listeners, remember that trends are your friends. To get a list of dividend growers to start your research, download the free Dividend Rockstar list at thedividendguyblog.com/rockstar. For the show notes and related content, visit thedividendguyblog.com/186. Next week, we'll put today's techniques in action by sharing 10 amazing dividend growers. Subscribe to the show now not to miss it, and leave us a 5-star rating. Until then, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.